What would be, as a real estate investor and a mortgage broker, what would be your top three tips for new real estate investors?
focus on focus on cash flow in particular. In this type of climate, we can't assume that valuations will absolutely increase over a couple of years, and you can't be that can't be your only investment thesis. To kind of piggyback off of that, there's a lot of things you can do to improve your cash flow for your own personal finances too. Second would be to understand enough about the tax to know how to ask questions and understand the ways that you might be able to leverage the advantages that we have with the Canadian tax system to ensure that you're not paying more tax than you need. And then the third thing is just to create a game plan for yourself and then to execute on it. And in many cases, you need a system, as we talked about earlier, to actually create an execution plan and to follow through with it and do it.
Welcome to Let's Talk Real Estate Investing. In this podcast, I bring you insights, experiences, and lessons from real estate investing professionals at all stages of their journey, along with industry experts who provide essential services to you to help you to succeed. Our goal, if you enjoy this episode, please hit that like button and subscribe to my channel. It helps me to continue to share valuable content with you. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach. Real estate investing isn't a one-size-fits-all. Your strategy should be unique as you are.
My special guest today on Let's Talk Real Estate is Kyle Green. He is the Rockstar real estate investor. We'll find out more about why he's a Rockstar real estate investor with 19 years of experience and the James Bond of mortgage brokers, because I always think he looks a bit like James Bond.
I'll take it.
So I will hand over to Kyle to tell us a bit about his background in real estate investing, and then we will talk a bit about his journey through real estate investing to what he's doing today. So over to you, Kyle, to give us a bit about your background in quick synopsis.
I've been a broker for 19 years. I got in the industry when I was 19. I got a job working for my friend's parents. I don't think they thought much of me. When I'm thinking back, she was the youngest daughter, the rebellious daughter of the three daughters of the family, and the two older daughters both worked for the family. And here's the rebellious one saying, "Hey, I've got a friend who wants to work for you guys." I'm kind of surprised I got the job and at first, but I became their protege very quickly, and they started to hand me lots of stuff. And one of the things that eventually they handed me was a fellow named Ozzy Durock had a franchise of theirs, and he was a real estate investor, guru or whatnot. So he used to throw big events in Vancouver, big ones with about 500 or 600 people twice a year, and about 100 to 200 people would attend a monthly meeting. Then at the ripe age of 20 or 21, something like that, I was then becoming their mortgage guy for their group. So I started to dive into it. I know that the other daughters were also invited and would go out to that. And initially, it was kind of all three of us kind of managing that. And I got the sense that they didn't really want to be there on the first Monday night of every month. And I was gobbling up the information, and I thought that this is really interesting, especially because before I got into mortgage brokering, I actually wanted to become a stockbroker when I was 19. So I thought, this is cool. Investing, it's kind of works with me. And then next thing you know, I'm doing public speaking in front of 600 people at investment functions, and then start to expand to different investment groups and started to dive into that and started to invest myself. Did my first joint venture with no money down when I was 21. It was a $1.15 million 5-unit property in Kelowna. So it's a pretty big deal for the first one, to be honest. I was looking for smaller deals. I was looking for $350,000 or $400,000 houses with basement suites back in 2009, 2010. That was what I told my realtor to look for. And he's like, "Hey, I got this really interesting one. It's listed for 1.4, but it's 5 units." And I ran the numbers. I'm like, "Oh, this one actually cash flows better than the others." So I ended up doing a joint venture on that. And since then, fast forward, I've done a number of different transactions and deals. I've lost count, but it's over 30 units that I've purchased. Many have been sold. Some I still own over my career, but lots of different types of deals. since then. And of course, working primarily with real estate investors on the mortgage brokering side as well. So anybody self-employed or an investor looking at a holistic game plan for how to build a real estate portfolio, how to make sure that the tax implications are considered as well with how things are structured. Because I find it's not easy to get advice on all of that legal, accounting, and finance. Somebody needs to be able to have a view of all three of them. Sometimes it's actually better to take a higher interest rate that then positions you to be able to save more in tax. And I find that sometimes if broker is doing their job and accountants doing their job, then those compete, right? The
Yeah.
accountant wants your taxes to be lower. Broker says, no, you need a higher income because you need to qualify for the best rate. But there should be more of a holistic view. So that's kind of the way we approach our business.
Tell us a bit from your business side, Kyle, from your mortgage. You've got Green Mortgage, you've got Atlas. Tell us a bit about the different companies you have and what differentiates them from each other.
Yeah, sure. Long story short, I've got Green Mortgage, which is my personal book of business, what I've been doing for 19 years. I've been in the top 25 for brokers in Canada since 2017. So it's coming up on like 9 years or so. We do a lot of business. I think last year we did 165 million. Our best year, like most mortgage brokers, was 2021. We did 250 million in mortgages. And I think over my career, we funded about $1.5 billion in mortgages through myself and my team. I also have Origin Mortgages, which is the brokerage, and that brokerage funds close to $1 billion a year. And we have 3 of the top 75 brokers in the country at our brokerage. So I help them build their businesses and grow. In addition to that, Atlas is a technology company that we started up, and we've been trying to make the mortgage process easier and faster, especially with the way that AI is improving and changing things. That's been another focus of ours. So yeah, trying, there's a few different things that we've been working on and looking at. All of it's related to mortgages or investing in some way, shape, or form.
So, how do you fit it all into 20?
Well, I find systems and processes are key. So Green Mortgage, we have different people that do different parts of the process. And most of my job in that business now is more on the oversight, jumping in when needed, more of the strategy side of things. Whereas I have people that process the deals. And one of the things that I think is really key or important for people that are trying to get out of their business is it's really hard to let go. It's really hard to put people in place and have them replace you effectively. And the only way to really be able to do that is to have a structured, systematic approach of how you take a whatever it is you do from front to back. So years ago, and this was we were working on different systems and different ways of managing our process, and we had tried a few, and eventually we settled on a system called Pipe Drive back in 2019. And what we ended up doing is I decided to take some time away from the business to work on it, not in it. Instead of working on deals and making money, we decided, the only way for us to actually grow past this point where everybody wants to talk to Kyle is to have a system where everybody knows exactly what is expected out of them. And as the file moves through stages, new things happen. So we basically broke it down and said at every single stage, what happens in the process, what automatic emails should go out to the customer, and what activities or tasks do we have to do at that stage. And then once you build all of that out, then you create a system, and then you just move the file along to the next stage, and then boom, the next tasks pop up. So it makes it much easier actually to hire and train people, because when you hire them and train them, you can say, okay, you're coming in and this is exactly what you do. And you just follow the instructions to a T. And when they log in, they can see all of the tasks they have to do that day, and they can see their pipeline of all the things that they have to do. And I think that that kind of stage-based system is how a lot of CRMs or systems are operating nowadays, because it just allows it to just break it down into components. The way that I kind of view this is it's kind of like trying to McDonald's the art of getting a mortgage, which is very complicated. Like getting a mortgage is super complicated, and you're never going to be able to simplify it to the point where 15-year-olds can do it. But if you look at McDonald's, like around the world, they have 15-year-old kids making burgers the same way in one country as they do in another, in one province as they do in another. And that's because if you go into the McDonald's, there's like beeping going on everywhere, and there's like all these things where, you put the burger on and it beeps you when it's time to flip it. It beeps again when it's time to take it off. You know there's exactly 3 pickles on the burger. You probably click the ketchup thing once, and the proper amount of ketchup comes out. It's probably exactly like 2 shakes or whatever of salt. Like everything is dialed in exactly the way it should be. And I think that that's how a business should be built if you want to get out of it, because then now you can say, okay, we have a system, we have a process. This is what each of the people that are handling the transaction do. The client knows who to reach out to instead of always just reaching out to the one person. Because I find otherwise what ended up happening, and probably what happened during the initial stages of me kind of hiring staff, was inquiry comes in and then I just delegate. But then if everything has to flow through you to create the delegation,
You become the bottleneck.
that you become the bottleneck and then you can only grow to a certain point, right? So that had to change. And so the investment in the system of time, resources, and money, et cetera, was a key for our success. And it came at a great time too, because we finished it in late 2019. We added some new, a new easier portal to upload documents online. And we did all this stuff months before COVID kicked in. Well,
And then went mad.
yeah,
I know. I was one of them.
right. I know. It was an insane time.
I think you did 5 mortgages for me within 2 years.
Yeah. You weren't the only one, it was just like a bang, 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 bang. I mean, real estate investing was hot back then. That's for sure. It had been hot. I mean, overall, my entire career, I've been blessed to be in a position where I kind of niched myself into something that's very hot. I mean, I had been for very long, honestly, until like mid 2022 was where the rails kind of fell off on that. So,
I like what you said about systems and stepping back. I think a lot of times we want to keep going, but then we do need to plateau, to step back a bit and to invest in those systems, because that way our clients get consistency and we can grow, because you
yeah.
do have to delegate, but you need to create that process that's consistent so that your clients get consistent service from whoever is in place.
So my team, this is kind of something that stuck with me, which was interesting to me, but I put my team through this super, super corny training, and it was a customer service training. But there's a lot of things, and even staff members or previous staff still remember some of the corny sayings to this day. But one of the keys that I was kind of taking away was, from a business perspective, it's not about knocking it out of the park, because you can't knock it out of the park every single time, even with the same client or the same circumstances, et cetera. It's about consistently being above average. And so those two things combined, if you just know what to expect and it's better than the average, but you know that it's always going to be above average, then that's the floor that you try to set. And of course, you try to knock it out of the park wherever possible. The objective is to first create the foundation underneath where it's always consistently above average. So no matter who you get in the company, there's information, documentation, a process, a system where they know what they get when they work with Green Mortgage, as opposed to, oh, I got Kyle, I got a great experience. I didn't get Kyle because he's too busy, and then I didn't have a good experience. Now, it's more of, Kyle can always be able to step in when there's something going sideways, but it's not a great experience to be waiting to hear from Kyle for 2 or 3 days. Like, if you have somebody always responsive, and then, hey, Kyle's always available now, because whenever he jump in, he could just jump in, as opposed to, you don't want Kyle on a phone call with a first-time home buyer for pre-approval, and they might buy in a year, when there's something going sideways on your deal at Friday afternoon, when you have a subject removal and you have to go firm a contract and the lenders want you to decline your deal. Like, you need to have that flexibility within the business structure to make it work.
Yeah. So, for those that are out there, we're not talking about this because we expect all of you to become mortgage brokers. But the reason why I'm asking Kyle these questions is, you can take this same advice and adapt it to your business, because as real estate investors, I think even I forgot that right at the beginning, it was that I was a business owner. Was treating it as like a hobby, something on the side, until I had the 5 properties and I had a mess on my desk, and those kind of things. So where you should, to do it properly, especially for those that are starting now, it's the best time to do it, is to record what you're doing, create these systems, so that then it makes it so much easier to scale. And as you said, if there's a plan in the future to remove yourself, and many of us want to be that passive person, once more time back into our days, then the model that you've created for your businesses and sharing is the model we want to implement into all businesses.
Yeah. Yeah. And I think there's certain investment strategies that require you to create a system and a process where it's repeatable over and over and over again. And so I know that whenever we talk about anything within the company, it's, okay, that's a great idea, but is that something we can implement? And how do we implement it so that it happens the same way every single time and everybody knows what was expected of them, et cetera? And if I was to take the business hat off and put the business of investing hat on, there are
Mhm.
certain types of investing businesses that require a systematic approach to doing something the same way every time. So rent to owns, for instance, is a great example of this. Like if you want to do rent to owns, you have to have a system and an approach for creating a huge lead funnel of all these potential tenant buyers. And then you have to funnel them down very quickly and sort through the ones that are serious, the ones that are not serious, drill it down to the ones that are serious, and then have a proactive approach on, okay, now what do I do with these people? And you kind of have to go through like step one, step two, step three, step four. And you have to have a marketing, part of the funnel at the very top of the funnel to get the leads in. Then you have to have a sales funnel. You have to have a operations funnel of like, how do you evaluate whether the lead is a good lead or not? And it's not just rent versus own. Every investment strategy has a core system that could be followed, and any larger company is going to have a systematic approach to how they do things, so they can do it the same way over and over and over again.
Definitely. I mean, like anyone doing buy and holds, how are they, you know, how are they getting their tenants in? How are they, all of that can be repeatable. Their lease agreements, all of those things can be repeatable too. Yeah, you're doing any property management on your own, or you have a property management company. There's always these things that that you do every single time. So why not create a system, and so that it's consistent and it
Yeah.
makes it easier for yourself. So, Carl, you are both a real estate investor and a mortgage broker. So
Yeah.
let's move now to the real estate investing side of things. Since we had the 2020, and that where everything was great, money was free, everybody was buying, everybody was selling, everybody was renting. And then now we get in 2022, we had the interest rates that caused the market to change, but we've also had regulations changes, all these things. So in your own portfolio, how were you dealing with all of this?
Yeah, I mean, the buy and holds are just holds. That's really what it comes down to. In some cases, depending on whether those were variable or fixed or whatnot, some of them became cash flow negative for a period of time, and that's not great. Probably the biggest adjustment that we had was due to government change, and that was the short term rental ban. So for us, one of our investments was buying a 7-unit building in Victoria. So we bought 5 units from one person, then two from another. And we ended up collectively owning the whole building. And the intention was that for that to be a short-term rental, and then the government banned short-term rentals. And we're like, whoa, that's a big investment. We paid $3.4 million or so for all the units. And now just have the government say, oh, you can't do that anymore. Like the valuation of small, 450 square feet to 570 square feet is the range for the unit size. Valuations for those fell immediately overnight. So you can't just sell the units and get out of it and wash your hands. Who all of a sudden can't generate the same kind of income you could before. It's been quite a journey. Now for us, one of the things that was key for us is during due diligence, we're looking into it. And one of the ways that I've always viewed mitigating against this was to look at municipal issues or pressures to conform with zoning. One of the issues with a lot of people is just buy a condo in a condo building. You not only have the strata itself that could battle you on allowing that, you also may have a municipality is battling you on, hey, you do not have a business license. The zoning does not permit commercial use, but a short-term rental is effectively commercial use. I always viewed that I thought the municipalities were going to be the ones that would be coming down with pressure to say, hey, you can't do that here because the zoning doesn't permit. I didn't expect it was going to be the province that just went bang, nobody can do it except for these
Across the board, yeah.
across the board. So the key for us was that the zoning permitted hotel use. And so for us, that seems like it's going to be our saving grace. So going through this and literally fighting the city, the province, spending tons of money in legal fees, tons of money in architect fees, etc. We've spent a lot of money on professionals to get through this. But the key for us is getting a hotel business license. And so we're very close to getting that. The city eventually granted that to us. But now they say, well, you need a building permit. Like, well, why do we need a building permit?
Ready to go.
To tell you, okay, well, your hotel, 10% of your units need to be wheelchair accessible. It's like, oh, geez, okay. So now we're getting quotes to blow out walls and make 10% of our units wheelchair accessible. And we have to have a washroom that's accessible to our staff, even though our staff just go to the coffee shop or whatever. You can't use a washroom inside of one of the units that you're cleaning. It has to be a third party. But to add an extra washroom into a common area, which is going into our back like laundry room. And then we
Mhm.
also have to add in another wheelchair accessible unit at a massive cost. It's unfortunate because we're at a point where we are not making as much money as we expected because we're off Airbnb and Verbo. We're only on like the hotel websites right now. And then we're also in a position where we have to keep putting more money into it to pay professionals to get through this. And then we're going to have another big bill to do the renovations. And hopefully, after all this is said and done, we will be a hotel. And then if you can't beat them, join them. Like this whole thing might at the end of the day turn out to be really good for us because we're going to be one of the only buildings in that area that will be able to operate in this way. We are set up that we already had a laundry room, which is one of the requirements. We have an area for a lobby, which is one of the requirements to be a hotel, and all these other boxes that we could tick off. But it has been a journey, and would I do it again? No.
If
So
only we had crystal balls, but we don't, so we have to adapt. I had to adapt my Penticton ones to doing co-living.
because I know when you first got them, that was the intention, short term rental, and
Yeah, and it didn't last too long, and then the regulations came in like very quickly after. What's in the plan for this year? Are you looking at any more real estate investing?
no. Frankly, the reason for that is we haven't really talked about this, but you know, I think in hindsight, understanding that we've always been able to make money in the mortgage business, and so
Mhm.
usually a bad year was no growth for us. And if I looked at for the first 15 or 16 years of my career, it was always either grow or I flatlined. And I think that in general, there's many different reasons for that. I think part of it was at a smaller size, my effort level makes a much bigger difference on a smaller entity than when my entity is bigger. My effort level is only a part of the whole machine. So
Mhm.
me being able to just turn it on and work extra hours and stuff. Yes, it makes sense when there's like two or three of us. Me extending my hours and bumping up by 20 or 30 or 50% or whatever makes a big difference in the bottom line. When the company's bigger, me extending my hours by that percentage, but there's 10 people on the team, it doesn't have as much of an impact on the results, I think. So that's one factor, which is kind of an interesting observation in hindsight. Secondly, the market. We haven't had a situation where interest rates quadrupled in my career ever, right? And so if you really look at like the last time interest rates increased to this magnitude, you're going back to the early 80s, and a lot of people lost their shirts in the early 80s and lost more than that. I think that overall, looking at like our revenues 2021 to 2023, our 2023 revenues were just a little bit over a third of what they were in 2021. And so you're downsizing, changing the company, restructuring it, doing all that kind of stuff. And because a lot of my clients are real estate investors, a lot of real estate investors kind of tap the brakes on, I'm going to see how this all plays out. So, a lot of market circumstances change. And so I think that sometimes you have to look at it and say, well, an investment is for the future and the future is great. However, we already have a lot of investments out there right now. And so I think that the key for us is mostly focusing on the investment of resources is going into the business and improving cash flows and improving efficiencies and that kind of thing. Because if you create more cash flow, you can always invest the cash flow later, right? You don't have the cash flow, then the investments that might turn out okay in the future doesn't help you today. And if you don't have the staying power today, then you won't be able to realize the profits from some of your real estate investments. Like if you are in a position where you're speculating too much on real estate, they're cash flow negative, and you don't have the ongoing cash flow to support that negative cash flow, then it puts you in a position where maybe you can't hold on to the property for long enough, and then you have to sell it, and you never recovered the valuation because you couldn't hold on to it for long enough to wait for the values to pop. I think that if you have control over when you sell the real estate, it's hard to not make money over time in many markets and many areas. But if you're forced to sell the real estate in an inopportune time, then I think that's where more people tend to lose money in real estate. And so it's important for us to just focus on like what generates cash flow and then make sure that that's where the effort goes.
Any tips for anyone that's coming up for renewals right now?
Yeah. So, I mean, a couple of things that I'm observing. Number one, banks have a new strategy on renewals. So instead of offering you a really high rate and hoping that you'll take it, There's more transparency. People kind of have an idea what kind of interest rates are going around right now. So the banks are having a new strategy, which is offering in many cases a lower rate than you would get if you were a new customer, which is kind of interesting because that has been different for a long time. And I think part of it is that it is getting more competitive in the space. Why would a bank let customers that they've paid to acquire and cost them money and then just let them walk out the door? Long story short, the cost of funds is much cheaper to retain an existing customer than it is to get a new one. Whether you're going through the branch or a broker or through a mobile specialist that works only with that bank, there are lots of funding costs and requirements and compliance and all that kind of stuff that's required to do that. Whereas a renewal, you have some guy sliding a piece of paper across the desk saying, "Hey, here are your options. Which one do you want?" And it's, he gets paid $25 an hour and he spent half an hour doing it. It's not even close to the same kind of level of costs that are included or involved with funding a new mortgage and all the compliance and underwriting and approval and funding and all of that. So they have a new strategy. So if you're just wanting to renew, you don't want to refinance for any purpose or reason, then I wouldn't be surprised if your existing lender offers a pretty competitive rate, maybe not the best rate, but a competitive rate. So we're telling most of our clients, get a quote. If you just want to renew it, get a quote first, and then you can send it to us or your broker, whoever, and just see what kind of rate are you getting, and is that competitive? Is it worth moving or not? Because sometimes, yes, I can get you a better rate, but sometimes we say, well, I can get you 0.1% lower on 500,000, so it's $500 a year in savings, but you're gonna have to go through an entire mortgage process. Is it even worth your time to go through a mortgage process? And for a 3-year or 5-year term, the total savings is 1,500 to 2,500. It's not a lot of people that would choose to do a mortgage in their free time, right? And so the value of it has to be good enough. Now, that being said, there are many reasons to do a refinance, which is different. And that's a rebook. And then the rates usually aren't as good when it's a refinance versus a renewal. Reasons to refinance. Some people are wanting to extend the amortization. So if they had a low fixed rate that they took in 2021, a lot of those are now coming up for renewal in 2026. So by re-amortizing the loan back over 30 years again, you can offset that increase in interest rates so that the payments don't really change. I find that if people took a 25-year amortization 5 years ago, and they have 20 years left, even if they're a rate that was sub 4, if they extend the amortization to 30 years, the payments stay about the same. Now, I know you're tacking on 10 years on the mortgage, but if the payments are the concern for you to hold on to the property, then that's one reason to consider that. Or if it's an investment property, then re-amortizing it means that you now can have more interest to deduct. You can have more cash flow to pay off your primary non-tax deductible mortgage or invest or do whatever you want with it. Also getting a line of credit to use to invest, do renovations. Debt consolidation is a big one. If you do have debts that need to be consolidated, and that's a really good reason to do a refinance instead of just a renewal, because the interest cost on those other debts are almost certainly higher than the mortgage cost. So yeah, there's different reasons to refinance. But I think the first question is, are you just wanting to renew it, or do you have a reason to refinance it? And then if you are wanting to just renew it, then check with your bank first, and then get some rates, and then you can shop that around pretty easily and say, hey, broker, what do you think? Are these competitive or not?
Can you extend the amortization period during a renewal?
Most banks do not allow that. No, would not without requalifying. So most of them require you to requalify to extend the amortization. So that's one of the reasons people are going through the refinance process to do that.
Right. I did something interesting recently where the cost of interest for my line of credit, I looked at just changing that over to a mortgage. And the mortgage, I was paying the same amount monthly, but I was paying $1,000 towards my principal instead of just interest.
Yep. Yeah. And so most lenders let you lock in the line of credit into a mortgage term. And usually the line of credit is prime plus a half. Sometimes they're even higher, prime plus 1. Sometimes you can get lower than prime plus a half, maybe as low as prime in some cases. But regardless, a closed variable, so the same product, basically a floating rate, a closed variable is going to be generally prime minus a half or often better. Usually most lines of credit are prime plus a half. So if you're getting prime minus a half, well, that difference per 100 grand is $1,000 a year of savings and interest cost. So in many cases, because a line of credit is interest only, often the payments are a little bit higher to lock it into a mortgage because it's principal and interest, but it depends on the rates and everything, right? So you have to kind of factor that in. But the difference in interest itself, you save about $1,000 per 100 grand that you're locking in. And so most people will then lock it in once they know that the money's going to be borrowed for an extended period of time. So if you think you're going to be able to pay it off really soon, then keep it on the line of credit. But that break even point is usually about 12 months because the line of credit's open. So there's no penalty to pay it off early, whereas a mortgage would be closed. So there'd be a
Yeah.
penalty to break it. But even with the difference in rates, after about 12 months, if you paid off the mortgage and paid the penalty, the savings on the interest rate often makes up for the penalty after about 12 months, anyways.
Yeah, that's what I found. Like I'm paying the same amount as for my mortgage payment as what I was paying just for interest only on my line of credit, and $1,000 of that payment is actually going towards my principal, where nothing was going towards my
Yeah,
principal. It's 12,000 for the year.
big. It's really
Yeah,
big. Yeah,
so
100%.
it's something to consider
Yeah,
for people to kind of have a look at. Because I know that many real estate investors use their line of credit as down payments on investment properties, and then that, as in mine did, grew.
exactly.
So,
You usually want to be working with most lenders allow you to have multiple segments inside of the line of credit. So you can then lock in different portions. And that's a personal thing. So not tax deductible. That was an investment. It is
mhm.
tax deductible, et cetera. And you can kind of separate it. It makes it easier when you go to your accountant and just for your own internal tracking. We usually like to recommend lenders that allow you to have multiple different tiers inside of the line of credit.
Anything that maybe investors are doing today with mortgages, and you want to say, don't do that or stop doing that. Is there anything you want to share?
I mean, the line of credit one's an interesting one for sure. We've been talking to a lot of clients about making sure that their tax deductions are maximized. So a lot of this conversation starts to get into the tax side, but the
Mm.
mortgage setup is a key to making sure that the tax side of things is maximized. So when you're looking at structuring things and figuring out, okay, how do I do this? There's some basics of just making sure that your mortgage has a home equity line of credit attached to it, and that way you have money available to invest. But you don't pay any interest unless you actually use it. So it's a really useful tool, especially when your mortgage comes up for renewal. Even if you don't need the money now, but you want to be a real estate investor, now's a good time to just tack on a line of credit. You have it available. You can cut a check whenever the opportunity comes around. So I think being ready and able to jump, and then you can get creative with it too, because you can do something called cash damming, which means you can actually take the so let's say that you take your down payment for the rental property, put it on your line of credit. You can convert that to a mortgage later if you want. That money borrowed for investment purposes, the interest portion of the payments becomes tax deductible. You can take it one step further though. It's a bit more complicated and we can kind of help with any clients that want to learn more about this. But there's also something called cash damming. And basically what you're doing is every month you take the income from the investment, so the rental property in this case, and then you take that income and pay down your personal non-tax deductible mortgage. And as you pay down the mortgage, the line of credit limit will automatically increase if it's what's called re-advanceable. So some lenders have re-advanceable, some don't. But if you do that, then what will end up happening is you're now paying down the non-tax deductible mortgage, the line of credit limit increases, and then you put all the liabilities and costs into the line of credit. So you're kind of like snowballing and accelerating the non-tax deductible pay down and the tax deductible pay up, I guess, if you want to call it that.
Mhm.
And so you can kind of accelerate things and move it in opposite directions. I think that's a really important key is like understanding that concept. We don't talk about it in my book, which you referenced. Thank you for doing this, by the way. But you referenced a
Yes,
Rockstar.
I wanted to talk about
Yeah.
that next.
So Rockstar Real Estate Investing is my book. We talk about the fundamentals of investing in real estate, how to do deal evaluations, how to. One of the most popular chapters is the $1 condo, which is talking about like buying a property and then flipping to yourself effectively. So doing the renovations and then refinancing to take hopefully all of your down payment out if possible. One of the things we don't get into in that book, however, is the tax component, but we also have a couple of books that are office that are related to the Smith maneuver, which is the strategy that we kind of go over here with cash damming and all that kind of stuff too. So yeah, we give some books, and if anybody your listeners would like a copy of our book, then give them to email us, and we can happily put one in the mail so they can read it. And the tax side, I think, is probably the area that we focus a lot of our energy and effort on because it's an often forgotten item and it's a unique and complicated skill set. So it's, not everybody really understands the tax stuff to a high enough degree to be able to advise people on this.
But it's actually once set up properly, it's a simple strategy that really helps. that
Yeah.
helps you bring down your mortgage side and helps you have more tax deductions on your business side. Do reach out to Kyle. We're going to share his contact information as part of this video. Email them and ask for those books. The Smith Maneuver, if you're an experienced real estate investor. For those that are aspiring real estate investors and watching this, Kyle's book, The Rockstar Real Estate Investor, is very simple. It's not very big. It's a thin book, but it will really give you the principles around real estate investing. I highly recommend it. How old were you when you wrote that book, Kyle?
30 or 31. I think we launched it in 2018. So I would have been 30 or 31 when I wrote it.
So Kyle is not only a real estate investor, owner of multiple mortgage companies, but also an author.
Yeah, that's great.
Any plans to write any more books in the future?
It's on the radar. Yeah. So the next book might be talked about, maybe a follow-up book to the Rockstar Real Estate Investing, but to be honest, it's probably going to be a book for training mortgage brokers. So basically taking people from step one, like, okay, I just got my license, to how do I do deals? Because the course that people take to get licensed does not actually tell you how to do transactions. It just tells you the legal stuff that you need to know and some other basics. How to use the calculator, when honestly, when you're a mortgage broker, there's calculators for you. So you don't need to know how to manually enter this kind of stuff.
Just plug things in.
Literally. So yeah, it's kind of silly. So my thought is, I think that training in the industry could be much better. As a brokerage owner, having better training is good for my agents, good for myself too, because then they don't have to come to you to ask every question. That information would be in a resource. But if you're creating all that content as a course, then you also kind of create stuff for a book too. So the book might be the next step is probably something along those lines. And I already have a name too. So
And AI is really good at helping you put things together.
so much faster. Right? Yeah, it's crazy.
It's much easier to write books these days. What it would be, as a real estate investor and a mortgage broker, what would be your top 3 tips for new real estate investors?
I would say focus on cash flow, in particular in this type of climate. We can't assume that valuations will absolutely increase over a couple of years, and that can't be your only investment thesis. If you are buying a property that's a cash flow negative property, but you have a lot of surplus personal cash flow, then that could be okay. But don't put yourself in a position where your personal cash flow is not great and then you're buying a property that's also negative. That just might result in you having to eventually sell the property before an opportune time, which is not a good thing. So that's an important key. And to kind of piggyback off of that, there's a lot of things you can do to improve your cash flow for your own personal finances too, which is re-amortizing your debt over 30 years, usually consolidating everything into the mortgage, because the mortgage payments and interest are lower than all of your unsecured debts like car loans and all that kind of stuff. So cash flow would be one of the primary things. Second would be to understand enough about the tax to know how to ask questions and understand the ways that you might be able to leverage the advantages that we have with the Canadian tax system to ensure that you're not paying more tax than you need. And then the third thing is just to create a game plan for yourself and then to execute on it. And in many cases, you need a system, as we talked about earlier, to actually create an execution plan and to follow through with it and to do it. The information is great, but as I mentioned earlier, that Ozzy Durock group that I used to be a member of, he called it the real estate action group, and he used those terms very clearly and intentionally, because all of the information means nothing unless you actually take it and use it and put action to it. There's nothing. Don't be worried about writing an offer on a property. Don't be worried about lowballing it. You have to be concerned about removing the subjects and being firm on it and saying, I'm guaranteeing the seller I'm going to buy it. But writing an offer, if you haven't done so already, is a great learning experience. You get to go through the motions and you start to learn and see, okay, what did I learn here? And so the knowledge is power, but it means nothing with you.
Definitely. You learn so much more by actually doing. I'm so pleased that you took some time out of your busy day. I don't know how you get everything done that you do and have a life, but it's wonderful to see you. Wonderful to have you on here. We really appreciate all your advice and wisdom that you've shared from both. It's great to have you as both the real estate investor and the mortgage broker. And just for everyone out there, just a plug for Kyle. He has been my mortgage broker since 2020, and they've done amazing things for me. They have stayed late at night when we need to take conditions off, and unexpectedly, because I was a backup offer, and they were able to come through and get me through so that I could get that deal. I've had really excellent experience with you, Kyle, and I do highly recommend you to other people.
I know you do. And I appreciate that.
Thanks for your time. And for today, Kyle and Debbie out for Let's Talk Real Estate Investing.